Welcome to this explainer. Okay, today we are officially putting on our sell-side equity analyst hats. We are going to rigorously tear down Archer Daniels Midland's Q1 2026 earnings filings. Now look, when you're analyzing a massive, incredibly complex agricultural giant like ADM, honestly, the market noise can be completely deafening. You've got shifting commodity prices, wild geopolitical trade flows, shifting green energy policies. It's a lot. So finding the company's true intrinsic value, that requires a highly disciplined, structured approach based strictly on what's in the documents. We aren't just going to skim the headlines today. We're going to extract the fundamental valuation drivers directly from their latest quarterly reports, piece by piece, to see exactly what the market is pricing in right now. So to find ADM's intrinsic value, we'll build out a solid analytical framework. First, we'll hit their core business model, then dissect the Q1 headline financials, dive deep into segment performance, map out the capital structure, and wrap it all up with forward-looking valuation drivers. Starting off with Section 1, Core Business and Market Position. We are establishing the qualitative foundation here. Listen, before we even think about opening Excel and modeling out the numbers, we absolutely must establish exactly how ADM makes its money. A quantitative model is literally useless if you don't understand the physical, operational reality of the business you're analyzing. Management's central mission statement is to unlock the power of nature to enrich the quality of life. Now, I know, that sounds like your standard fluffy corporate marketing speak. But for an analyst, this actually acts as the guiding thesis for their entire global footprint. Fundamentally, they are a massive processor. They take raw biological inputs straight from nature and systematically refine them into higher value products for global consumption. And their competitive advantage stems from four massive pillars. They operate as an essential global supply chain manager, a premier nutrition provider, a trailblazer in health products, and a cutting-edge innovator in bio-based solutions. This structure allows them to capture value at every single step of the chain. We're talking everything from basic crop origination and moving grains across the ocean, all the way down to advanced precision fermentation for pet food. They are heavily vertically integrated, and that integration acts as a massive competitive moat, securing their cash flows against upstream volatility. All right, let's move into Section 2, Q1 headline financial results. This is all about separating operational reality from accounting noise. Let's jump into the actual Q1 2026 numbers and start bridging the gap to ADM's true earning power. Taking a top-down view, the filings show steady year-over-year revenue growth. Revenues crossed $20.4 billion in Q1 2026, which is a nice step up from $20.1 billion the year prior. That top-line growth pulled gross profit up slightly alongside it, hitting $1.22 billion. Now, at the bottom line, reported net earnings were essentially flat, coming in at $298 million versus $295 million in Q1 2025. But hey, as analysts building out unlevered free cash flow projections, we know that reported net earnings almost never tell the whole operational story, right? Which brings us to a crucial point, the gap between reported accounting figures and adjusted operational realities. There is a very specific 9-cent gap between the reported GAAP earnings per share of 62 cents and the adjusted EPS of 71 cents. So, what exactly is driving that difference? Well, to build an accurate valuation model, we have to strip out the specified accounting noise to reveal that clean 71-cent adjusted EPS baseline. The filings outline a $55 million non-recurring charge from an equity method investment, $29 million in impairment and restructuring charges, which is then offset by a $47 million gain from selling off assets, plus a $10 million discrete tax adjustment. By backing out these one-off events, we get a much clearer, normalized picture of ADM's recurring cash-generating ability. And that is absolutely vital for any accurate DCF projection. Moving to Section 3, Segment Performance Deep Dive, finding the catalysts for margin expansion. Now that we have our baseline established, we have to look at the segment level to see exactly where their total $764 million in adjusted operating profit was actually generated. And wow, a huge structural shift in ADM's business mix occurred this quarter. Historically, ag services and oilseeds has always been the heavyweight, right? But in Q1 2026, carbohydrate solutions took the dominant lead, generating $356 million in operating profit. That fundamentally alters the typical profit mix we're used to seeing. Nutrition followed up with $135 million. Let's break down exactly why this happened, starting over on the agricultural side. If you look strictly at the ag services and oilseeds segment, you're going to see a massive $139 million drop year over year. That brings total segment profit down 34% to $273 million. Honestly, if you're just casually screening the headline numbers, that might look absolutely alarming for their core business. But again, as analysts, we must separate the signal from the noise. The filings explicitly state that this drop was largely driven by roughly $275 million in net negative mark-to-market and timing impacts. Guys, this is unrealized, non-cash accounting noise based on fluctuating commodity prices, specifically tied to a strengthening biofuels environment. If you actually look past that paper loss and adjust for those non-cash charges, the operational execution was phenomenal. The Ag Services subsegment actually saw a 26% operational increase, masking incredibly strong export activity to China and a really robust North American corn export program. Meanwhile, let's talk about the real standout catalyst here, carbohydrate solutions. This segment was up a staggering 48% year over year. The primary driver was a massive $94 million jump in the Vantage Corn Processors division that was fueled by strengthening margins in corn dry milling ethanol operations, highly effective risk management, and very favorable policy incentives. This is a textbook example of how regulatory clarity around biofuels directly translates to ADM's bottom line and structurally expands their segment margins. Finally, the nutrition segment proved it is absolutely still a viable growth engine, successfully rebounding 42% to $135 million. Human nutrition was up $29 million, riding on the back of higher flavor sales and building momentum for natural colors. Operationally, their Decatur East plant continued its steady recovery, and animal nutrition saw an $11 million bump as the portfolio shifted toward higher margin products and crucial optimization initiatives really began to pay off, which completely supports our long-term margin expansion thesis. All right, Section 4, Capital Structure, Proving Balance Sheet Health. Any fundamental valuation requires a pristine look at the balance sheet to assess the true capital structure and leverage. You simply cannot calculate a weighted average cost of capital, your WACC, if you don't know the cost of the debt servicing the business. By bridging from their $9.3 billion in total debt down to an adjusted net debt of $8.7 billion, which we get by subtracting their $591 million in cash and equivalents, we confirm their capital position remains highly disciplined. Seriously, this level of debt is entirely manageable for a company pulling in over $20 billion in revenue in a single quarter. And this explicitly establishes the target capital structure weights we need to calculate our overall cost of capital. That disciplined capital structure yields a trailing four-quarter adjusted return on invested capital of 6.4%. For anyone building a DCF model, this is your foundational metric right here. It tells you exactly how efficiently management is deploying capital to generate returns above their WACC, which is a critical input for your terminal value assumptions and long-term free cash flow forecasts. And management's stated 2026 priorities double down on this exact dynamic. They are hyper-focused on rigorous discipline around cash, cost, and capital. They're carefully balancing the generation of strong cash flow and improving manufacturing costs against aggressively investing in high-growth opportunities. We're talking growth CapEx going toward precision fermentation capabilities and bio-derived materials. These are the investments that will fuel future growth. Which brings us to our final section, outlook and valuation, projecting intrinsic value. Let's pull all of these operational realities together and apply them to management's forward-looking guidance. This is where the valuation thesis really solidifies. ADM had a previous 2026 adjusted EPS outlook of $3.60 to $4.25. But by securing constructive policy clarity around biofuels, specifically the finalization of the U.S. Renewable Fuel Standard obligations for 2026 and 27, management confidently raised its full-year EPS guidance floor by a massive 55 cents. They are now projecting $4.15 to $4.70, directly citing expected year-over-year earnings improvement in their crushing and ethanol businesses. And this creates such a fascinating tension driving ADM's valuation today. On one hand, you have this explosive green energy growth potential driven by biofuels and sustainable agriculture. But on the other hand, you have a legacy processor with historically disciplined capital returns and incredibly steady cash generation. It is a very unique blend of a classic value stock operating in a suddenly high-growth policy environment. But of course, we aren't the only ones who notice this. A quick valuation check shows that the market is already pricing in some of this momentum. Right now, ADM trades at a forward price-to-earnings ratio of 16.53x. That is noticeably higher than the broader industry average of 14.34x. Basically, the market is assigning a premium multiple to ADM because of that strong nutrition segment recovery and the massive biofuel tailwinds we just unpacked. So, we arrive at the ultimate question. Now that we've isolated the operational catalysts from the accounting noise, mapped out the net debt structure, and quantified the biofuel tailwinds capping an earnings ceiling of $4.70 per share, what is ADM's true intrinsic value? I challenge you, take these adjusted margins, calculate your own cost of equity in WACC, apply that 6.4% ROIC, and run these inputs straight through your own discounted cash flow model. Is that 16.5x premium multiple actually justified by the unlevered free cash flow? Run the numbers and find out. Thanks for joining me on this explainer, and keep analyzing.